Welcome back to Miller Momentum. I'm going to keep today's episode short and simple because that's the whole idea of it. Simple implementation of investing strategies and ideas beat more complex approaches. We're going to be looking at Robbie Money as a case study. But first, a disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. So, why Robbie Money for this case study? Because he's doing something that, on the face of it, seems really similar to my own investing approach. He's combining the momentum and value factor premiums in equities. We do diverge, however, in the following ways. One, he doesn't do managed futures or any alternatives that I'm aware of. Two, he's explicitly trying to beat the market in absolute returns as his primary objective. And three, he has a tactical approach going on that involves continually retooling and shifting across different equity factor ETFs. Like me, though, he is completely transparent with his performance and investment history. And you can see how he's doing. He uses Snowball Analytics just like I do. Now, I really like the color scheme of his channel. I'm a huge fan of dark mode in general, so I'm digging the black backgrounds. And he also does some really cool deep dives into various ETFs, kind of like what I do, but with a focus again on momentum and value equity funds with, the factor tilt. He gets into some other things like SCHD and QQQ and some other really cool things. So he does actually debunk some finance influencers too, and clears up some misunderstandings about some of these ETFs. If you go up to his description, he states that he was a financial advisor for 8 years, and so he's now taking the experience of that career and applying it to looking at ETFs and taking a tactical approach with ETFs and trying to accomplish kind of the same things that a lot of people do with trading individual stocks, but at the ETF level. And he's built a lot of custom ETF comparison tools, some of which are very helpful when you're shopping for ETFs and seeing which one will work best with your strategy. But I think it falls apart for him when he tries to approach portfolio construction in this overly tactical, overly complicated way. Uh, if you visit his public portfolio, he fully discloses his strategy. You can see the amounts, everything. He's got, 40% in US momentum, 40% in US value, 10% in international momentum, 10% in international value, and some waiting to sell things. So you can see that he was trying some strategies in the past that I assume didn't work out that well, including trying to play the trades that our elected representatives do in Congress. And I know that that was trendy a while back. And hey, I'm not judging. We've all fallen for trends, haven't we? Anyway, but it's really cool. You can see everything. If you go to the growth tab of Snowball Analytics, it'll show you actual portfolio growth over time and portfolio performance for the current portfolio that he holds. And you can get a pretty good sense of it going back a year, 5 years. Probably doesn't make sense to go back much further than that because there just wasn't a lot of money in the account. But I'm going to be focusing on a 1 year performance review here, just because that's the best window for his current strategy. So Robbie's got quite the complicated strategy going on here, as you can see from the screenshots that I've put up. He's up about 24% over 1 year, which I suppose isn't too shabby at all. But, and it's a big but, if you just went with the simplest implementation possible, where, you know, you have conviction that value and momentum are going to return a premium, the constraints seem symmetric. So, on the face of it, there's no reason to suppose that value or momentum is going to do better, one or another. And if you take the assumption that, well, I don't know the future, so I'm just going to invest globally, then doing a 3 ETF allocation where you just put 50% in global momentum and 50% in global value would be the simplest approach, right? To trying to do this strategy of combining momentum and value. Now, US investors, we don't have access to something like IWMO. I know it's something that I you know, frequently mention on these videos because I really want that ETF. There are other global alternatives too, like Vanguard's Global Momentum Factor Equity Fund, VMO. But again, that's not really available to US investors. So, what is available though are the Invesco um, funds, and I personally prefer the iShares funds, so that's what I went with for this demonstration. So we just build this 3 ETF portfolio. We've got uh, MTUM at 30%, IMTM at 20%. So together they approximately give a global momentum factor. And then we've got AVGV from Avantis for the global value factor. So just three tickers, right? 50% in value, 50% in momentum. So let's see how it goes. So already over 1 year, we're at 29% gains compared to Robbie's 24%. So all of that extra complexity actually resulted in a portfolio that gives a lower return than a much simpler portfolio. We can see that, risk adjusted metrics and everything, pretty good. The cost of this portfolio is a little bit cheaper than Robbie's. And so it seems that in this case, simplicity wins. But will simplicity always win? Most of the time, yes. This is a known result in forecasting models that goes back to Makrodakis and Hibben in 1979. In 2022 and 2023, they started applying their findings to the realm of investment decisions. And while they weren't focused on portfolio design per se, they were actually looking at whether complicated forecasting models would beat or lose to simple forecasting models. And as it turns out, the simple models almost always won. I would argue the results of their research are generalizable. I mean, after all, what is a portfolio but a prediction, a forecast about what should meet needs over an investment horizon? In a sense, our portfolios are forecasts. Now, Goldstein and Gigerenzer and De Miguel and Gerlapi and Upal, they've also done some interesting, relevant work in the investing field. Um, just comes to mind optimal versus naive diversification. How inefficient is the 1 over N portfolio strategy? And another paper would be fast and frugal forecasting. They're all interesting reads if you're interested and of a more academic bent. If you're not, I totally understand. You're not going to hurt my feelings if you don't read those papers. But back to the topic at hand, there is a very high probability that a 50-50 mix of IWMO or VMO, depending on your preference, and AVGV, so 50% global momentum and 50% global value, rebalanced annually and with an ad hoc 5% absolute band rule, will beat Robbie Money's strategy over 5 or more years. I'm pretty certain about that. I'd put it at a 95% chance. And as long as Robbie Money discloses his strategy, hey, we can track it. Speaking of, and you probably saw this coming, There is now a fifth Miller Momentum Portfolio framework in the lineup to honor folks who boldly decide to go with an all equity portfolio. Whew! Listen, I'm not one of you. I've already talked at length in my 2026 portfolio update about why I've committed to the Atlas portfolio for my employer retirement accounts. But not everyone is like me, and a 50-50 momentum and value equity portfolio still very much aligns with the themes and emphases of this channel. I mean, it's still strategic investment and trend following, just only in equities. One thing you'll notice about all of these frameworks, they can and should be built with a maximum of 6 ETFs. Fewer is better. The count would be lower, but alas, US investors may want to split the factors up between domestic and international ETFs. We don't have as many global equity options with a factor tilt as our European friends and folks in other countries like Canada and Australia. You'll never see me build or run anything with more than 6 ETFs in any of my accounts, partly because, well, that's the limit I've set for myself. Simplicity is key, and the data bears that out. And speaking of simplicity, Robbie Money's channel convinced me to do more digging into VFMO, Vanguard's US Equity Momentum Factor ETF. And in the absence of VMO or IWMO, I am now convinced that VFMO is probably the best single fund solution for the momentum allocations in the Miller Momentum portfolio frameworks, at least for US investors until a global fund becomes available to us. While it is certainly defensible and maybe even optimal to do a split with the iShares MTUM and IMTM ETFs, Vanguard's own research shows that most diversification benefits from international equity market exposure are already gained at 20%. A 50-50 split between VFMO and AVGV, well, it ticks that box and then some, and it's far simpler. And look at this. VFMO is getting similar alpha over the Russell 3000 index as AVGV is to the total world stock market. And it's doing it with a lower PE ratio and price to book than its index, the Russell 3000. Indeed, just like Avantis is using momentum as a secondary factor to support its capture of value, interestingly enough, Vanguard is using value as a secondary factor to support its capture of momentum. Look at the symmetry in their cap size holdings too, and their sectors. I think I prefer VFMO's diversity in terms of cap size and industry to the international exposure of splitting the momentum slots between the two funds. So, to keep things simple, as Marie Kondo would encourage, and to decide once, as my wife tells me Kendra Adachi encourages in her Lazy Genius book, I'm classifying VFMO and AVGV as the best in class options, in my opinion, for US investors to build the Miller Momentum portfolio frameworks. International investors would, of course, use VMO or IWMO instead of VFMO. All Miller Momentum portfolio frameworks can now be found on Portfolio Lab, and you can see my own Atlas portfolio on my YouTube channel page at the Snowball Analytics link. Well, I hope you enjoyed this episode of Miller Momentum and the outfit change midway through since it was recorded across different days. I hope you noticed. The bow tie, especially. Anyway, I'll close with a friendly challenge to Robbie Money, a friendly invitation to a competition. The Nadir portfolio, whether implemented with a 50-50 split between VFMO and AVGV, or VMO and AVGV, or IWMO and AVGV, it won't matter. It will beat your strategy over the next 5 years. I'm almost absolutely certain. Game on? Hey, and to the viewers out there, don't forget to like and subscribe. You do want to see who wins, don't you? In the meantime, keep it simple.